So it is that time of year again to review your livestock risk protection coverage. If you guys haven't looked into this program, this is probably the most opportunistic time to put a bottom on the cattle market. This is one of my favorite quotes: be fearful when others are greedy and greedy when others are fearful, which is what's happening right now. All we're hearing is news about why the cattle market's going to keep running up. And I'm going to give you guys some insight, at least into why I think that may not happen. If it does, and you buy into this program and it keeps going up, this puts a bottom on it but leaves the upside on there. But I think we very well could be reaching the end of this incredible run that we've had here. So one of the reasons I think that is if you're kind of a charting person, when you look at anything, whether it's wheat or corn or oil, when these commodities peak up like this, when you have bubbles, they never stay up there. It doesn't matter what commodity it is, whether it's wheat or corn or oil. And there is no reason to think the cattle market's an exception to that. Last time we had this big run up, I think in 2014, it fell apart within about 6 months, and it's very possible something like that could happen again. So this is the feeder cattle futures chart. I just pulled this off today, and you can see we actually ran up a couple more bucks today. We are almost up at a record high again here. So there's never been a better time to put a bottom on the market than now. This LRP or hedging or any kind of price protection is going to allow you to put a bottom on this market and get one more year out of it. So one of the reasons I think that we're probably going to hit the end of the line here eventually is there's red flags all over in our economy that a recession or some sort of reset could be coming. One of those is this outstanding credit card debt. So this actually shows 1.2 trillion here. I think we're closer to 1.3 trillion now on the credit card debt since I made this video. That shows you that people are running out of money and they're using credit cards to finance themselves, right? The interest rate on those $1.2 trillion of credit cards is now up to 19%, even less sustainable now to keep balances on cards and actually claw back out of that. The personal savings rate of people since COVID has gone back down now to about 3% as far as the amount that they're saving of their disposable income. So what all of these numbers point towards is the consumers are running out of money. We've got other pressures now from tariffs, a lot of economic uncertainty from all these layoffs in the federal government. There's just a lot of things that could upset the apple cart here. So there's, how do we put a bottom on this and get one more year out of it, right? And that's what this video is about. So common marketing options for calves, I'd say actually for most of the livestock producers around here, it's the do nothing approach. And the last 3 years, that has worked out pretty good, right? Because it's done nothing but go up. But there is a time where this is going to reconcile itself and get back closer to the moving average. So do nothing right now certainly is still happening, but not something that you should be doing, obviously. Hedging is another way, which would be a good way right now to protect these cattle as well, where that's basically you just set the market at where it's at. If it runs up, you don't get the upside. If it goes down, then you don't have the downside risk anymore. The problem with hedging is there's margin calls, which a lot of producers don't like. You have to set up a brokerage account, which a lot of ranchers don't want to do. And then the contract size. So you have to do it in 50,000 pound lots or about 180 to 100 head of calves per contract. So it's harder to hit that number correctly to actually reflect the number of cattle you have if you're a smaller producer especially. Put option, that's another good option, but that requires a trading account. That's just insurance. If the market drops a certain percent, it kicks in and it will put a bottom on the market for you. You pay a premium to leave your upside open, but if it falls apart on the downside, then somebody else took that risk for you. So that's a real good option to accept. It's 50,000 pound contracts. You have to pay for it up front, and you have to have a trading account. So that's why the government came out with LRP. So LRP allows us to basically have a subsidized put. That's all it is. It's insurance on the market going down a certain percent. There's unlimited upside when you do this, so that's good. So if this continues to run up, which we all hope it does, right? And we get $3 calves, then $3 feeder cattle on the futures, then we get to experience the upside. To limit your downside, you have to pay a premium on the other side of it, but the government's paying part of your premium for that put as well. And the other advantage of using LRP, the livestock risk protection, is that you can do any number of cattle and you don't have to pay for it until the month after the trigger date of this program. So LRP is becoming increasingly popular. This market has kind of hit a peak, right? So what is LRP? It's called Livestock Risk Protection. It's a government subsidized program, just like crop insurance, except this is for livestock marketing. It's basically a subsidized put. In other words, the government's paying for half part of your cost of this program. You can do any number ahead from 1 to 25,000. So a huge amount of range as to what we can do with this program. You don't have to price them all at once, so we could do 50 head today, and then you could wait and do 50 head tomorrow, or any number in between there if you want. Provides downside coverage with unlimited upside, and that's the biggest thing, is we give up a little bit of our profit here to protect the downside, but that also leaves all the upside open, which if this continues to run up, which I think is relatively unlikely, but if it does, at least you get all that upside and you didn't miss out on that as well. So how does this work? There's quotes released each day after the market closes, so it's based off of whatever those puts and calls are, or whatever the puts are trading for on the futures market. So every day when the market closes at 3 p.m., we get new premiums for you guys, basically, in different coverage levels that are available. You pick the time frame you want to market the cattle. Like I said, we usually suggest if you're going to video sale in July, that's when you're out of the pricing risk. That's when we want this to trigger. When we do it that way, we need to guess roughly what weight those cattle are in July, so we go backwards on your weaning weight, obviously, to that point, right? And then choose a percentage of the price to insure. So usually guys want to do like 95% through us because that ends up being somewhere around like $6 a hundred, which is what they can tolerate. Some guys are okay with being right at the market because the market's so high. It's just whatever your tolerance is for the premium portion of this, the more you want to pay, the higher we're going to lock that market in at, right? And then premiums due the first of the month after the coverage ends. So you have till after that trigger date, the first of the month after that is when your premium's actually going to get billed to you. So much better than doing a put that way. This futures market based. This isn't based off of what you sell your cattle for. That's one thing to remember. As the futures market moves up and down, so does the price of your cattle for the most part. But if for some reason your cattle go at the end of the sale or whatever and you get a lower price than everybody else, this isn't covering that kind of risk. It's just covering whatever happens with the futures market up and down here. That's the most important thing to remember. So this is the feeder cattle index. That's what it actually pays off of. So your coverage is based off of the futures market. It triggers at the end off of this feeder cattle index. And this usually is within a few dollars of where the futures is. It can spread out, but historically it is usually lower than the futures, not higher, although there has been some times when there's positive basis. But it's just important to remember this feeder cattle index is what it's going to pay off of. This is an average of all the cash sales in the U.S. for the past week of feeder cattle in a certain weight range, basically. But not to get too far out in the weeds, but basically if the cattle market collapses, this program is going to pay. If it stays up, it may not pay, but then you're going to be okay. Right? So there's a few rules just to know about this. You can't sell the cattle more than 60 days prior to the end of the coverage period. So if we set this up so that it's going to trigger in October and then you hit a big drought, you want to sell all your cattle off in June for some reason, that'd be more than 60 days prior to when this thing triggers. We need to own the cattle, actually have physical possession of them at least 60 days prior to when the end of this coverage comes. So that's one thing to remember. You don't have to sell the cattle by the end date. So if you want to retain your heifers, even though they're on this program to protect the price on them, you can do that. You can keep them in your herd for 10 years if you want. So there's no rule saying you have to sell the cattle. The only thing is we have to have possession of the cattle at least within 60 days of when this stuff ends. And that's just to stop people from speculating with this program. We need to actually have physical ownership of the cattle. Need to report deceased livestock within 72 hours. How we usually handle that is we have guys just insure maybe 95% of what they have, so we have a death loss cushion in there. If you have a big death loss event like a spring storm or something, you need to report the loss of those calves to your agent within 72 hours. And then if you do that, even though those calves have died, they will continue on in the coverage until the end and actually trigger a loss or not. If you don't report that within 72 hours, then technically those cattle are no longer covered on this insurance, but you pay the premium on them. So that's a good reason to build some death loss in here, like not do all of them, because it gives you a cushion for maybe forgetting to report a few calves if they die or whatever. We can do unborn calves, so if you haven't calved yet, we can still put coverage on these things. They just assume they're half steers and heifers for this program. Great way to lock in a high market for next year's calf crop. So So you don't have to have calved out these cows for this coverage to trigger. On feeder cattle, there's 2 weight classes, 0 to 600 pounds and then 600 to 1,000. So kind of calves and yearlings, kind of a category or whatever. If you stay in that 0 to 600 pound range, then we get 10% more coverage for the different sexes of the cattle. If we get up to the 600 to 1,000 pound range, then the steers are just right at the futures market and the heifers are 10% back. But a lot of this doesn't matter a lot to you guys. If we can time this to end, usually when you're underneath that 600 pound mark, you get another 10% of coverage basically. So fed cattle, if you want to retain ownership and put them into a feedlot, we can do that. There's some different rules on this program, so if you want to do that part, please give us a call and we'll walk you through that part. But that's definitely an option. So how it would work is we'd send you quotes every day. What you see on the screen right here is an example of a quote where we picked the 97% level. So the market or your coverage level right here was at 275. That's where the market was. 97% would be 3% out of that. So when it gets below 269 for that feeder cattle index in this scenario, when we get below that level anyways, when the trigger date comes, it'll start to pay dollar for dollar when we're below there. So here's just a quick example of how this works. So we're going to say it's January 1st, you preg-checked your cows and you have 100 bred cows that say haven't calved yet. So you want to lock in a bottom on this calf price for next year. You plan to sell your calves in October at 600 pounds. We're going to figure you might have a 5% death loss, so we're going to put a 5% cushion in there in the number of calves that we use. So we're only going to price 95 head of calves on this program. October 15th is as close as we can get for the date when you probably will sell, so that we can only pick 1 day per month for this program to trigger, and that day I'll ratchet forward every day it closes. But for now, we could do October 15th is what we could do on this program, which is 42 weeks out from January 1st. So we're going to price onborn calves 42 weeks out on the program. We choose a coverage level of 93% of the current futures price, which we can do for $7 a hundredweight on this quote, or 7 cents a pound. So we give up 7 cents a pound on these calves that we're pricing to put a bottom on our market at 247 here. So 95 head at 600 pounds is 57,000 pounds insured. It's costing us 7 cents a pound or $3,900 to put a bottom on the market for these calves here. So we set a 247 coverage price that was set on January 1st. It ends October 15th. So whatever happens on October 15th with that feeder cattle index is what's going to trigger this. We're going to say the market reset. So we had a recession or we hit some bird flu thing here. And the market went back to $1.75, which is pretty close to where the moving average is of this market. So it's very possible this could happen. So we go 247 minus the $1.75. So we've got a $72 per hundredweight loss or a 72 cent a pound loss for the insurance when this triggered October 15th. So the 57,000 pounds times the 72 cent loss would give us a $42,000 loss. And our premium in that example was $3,200, I think. So loss rules, notice the loss are automatically submitted through us so that you don't have to worry about calling us and saying, hey, I think I have a loss in this program. And you have to prove ownership of the cattle. So it's really important that we insure these cattle under the same name that they are owned as or are getting sold as. Usually if they've triggered but you actually still have the cattle, which is the most common thing in this program, especially if you're a video sale guy, we would go back and use vaccine records at branding, a statement from your vet, something to prove that you actually own the number of cattle that we said that you did on the insurance. So that's been pretty straightforward on the losses so far. So why look at LRP right now? So look at this chart. The historic average for the last 10 years in the cattle market has been floating around, well, way back in the 70s, of course, inflation adjusted. It was at 50 cents. But we hit a peak once in 2014. It dropped off within a year back down to about that $1.20 moving average. We're now at 272. Today, it actually went up another 3 or 4 cents since I did this presentation. So we are almost up to 280 on this cattle market. We're at almost historic highs. This thing is set up on a bubble and it could fall apart at any moment, basically. And we can put a bottom on this thing about 5% below the historic high prices for $6 a hundredweight. So if we're doing 500 pound calves on this stuff, it's costing you $30 a head to put a bottom on the market where it's at right now to guarantee you somewhere around that $1,800 a head calf at sales time. So what should I do? As soon as you preg check, put LRP coverage on the onborn calves, price into your yearlings you plan to keep ASAP. And basically, just do whatever you can to limit risk on this. This is one tool if you decide you want to hedge, because it doesn't cost anything to hedge. It's just going to set your price where it's at. You lose the upside. If you want to go that route, do that. But do something, because this thing is certainly on a bubble and it's fragile, and there's no better time to look at doing this and locking in one more year of this incredible run that we've had in the cattle market. So if you want to get started through us or anybody else that sells this, you contact your agent. You can set up a policy. It costs nothing to have the policy set up, but you need to get that part done first before you can put the cattle on. This doesn't commit you to insurance. It's just a preliminary paperwork to get your entity cleared so we can have it set up in the background and ready to go if you want to endorse cattle. And once you decide to price the cattle, we need to know between 3 and 5 p.m. that day that you want to, the number of head that you want to get done, the weight range, and the trigger date. And then we just send you an e-sign thing. You click a couple deals, and then they go on your insurance. And then if it pays, if it triggers, the loss takes care of your premium. If it doesn't trigger, you pay it, but that means the cattle market stayed up, right? Big thing is cattle must be insured under the name that they are owned under. If you're a ranch that has multiple people that, like maybe your kids have 10 cows that sell separate from you, and that we need to do all that correctly. So we need to structure this under the names of the people that sell the cattle. But other than that, please look at this program. I think right now is a great time to put a bottom on the cattle market and stretch this thing out one more year.